Do you think that World War III will never happen, or do you think that it may have already started? Well, according to Zoltan Pozsar, who is one of the world's leading experts on the Fed, the shadow banking system, and the repo market, he says that World War III may have actually already started. And if you take into account economic wars, it has definitely already started. Ready? Let's dive in. Real quick, for those of you who are looking for a way to invest to protect yourself from economic crashes and hyperinflation and deflation, my portfolio allocation mastery course is almost done. I'm working on it as we speak. It's just days away, and there's a pre-order discount that will only be available until I actually launch the course in just a couple of days. So if you've been sitting on the fence and you're interested, I've got the discount link with the discount code in the description below. The price will go up once I launch the course. All right, take a look with me at this article from Credit Suisse. This is from Zoltan Pozsar, and he is, like I said, one of the world's leading experts on the Fed, the repo market, and the shadow banking system. I know much of what I know about how the banking system works and the repo market because of the research that this guy has put out there. He's a very intelligent guy. Now, he's wrote this article that basically says there are many different types of wars, and due to what's going on right now, it looks like we are already in a war, and that the Federal Reserve will likely have to continue tightening and hiking for a lot longer than most people expect. So we're going to go through this article. We're going to break it down through a couple of key points that he talks about here. Just as an overview, we are currently in an economic war between major countries all over the world, including the United States, Russia, and China. The forces that are at work right now are very long moving and have lots of momentum, and so it's more likely that this continues longer than it just resolving itself automatically within a couple of months. And because of these factors, it looks like there's a much higher likelihood that inflation sticks around for a lot longer than people think, meaning that the Federal Reserve will continue their path of hiking until they get control of inflation, meaning we have a lot longer to go in this tightening cycle. All right, let's take a look at the article here. So first, he points out that war is inflationary. Wars come in many different shapes and sizes. We've got hot wars, cold wars, but we also have economic wars. He points out that inflation did not start with the hot war in Ukraine, but the war did fan the inflationary currents that have been underway already. So this is completely accurate, and everybody without short-term memory loss remembers that we were starting to experience a lot higher levels of inflation far before Russia invaded Ukraine. However, that doesn't mean that war is not inflationary. It just means that it has made it worse. We've experienced more supply chain issues. We've experienced more disruptions in the global energy supply. We've experienced a lot of problems as a result of this that have contributed to prices going up. So you might be asking yourself, well, why is war inflationary? And so we have to look at what war does. Number one, it takes real resources like steel and iron and lead and energy, and it takes those things and diverts them to something where all those resources are just getting destroyed. That's what weapons are. You're sending people to go destroy things like buildings. So it takes supply away from the market, from everybody else who might want to use that for other things. That means that the price will go up. If demand stays the same, supply goes down, price is going to go up. So because war is by definition the destruction of wealth and resources, it's going to make prices go up for all of the remaining resources. He points out here that the consensus of the expected path for monetary policy rests on two hopes. Inflation is about to peak, and that we are near peak hawkishness. Now, these two go together, right? Because if inflation is about to peak and inflation just starts to come down every single month, then there's no need for the Federal Reserve or any other central bank to continue hiking rates because they've solved the inflation problem and inflation is going to come back down. They don't need to hike rates anymore. But as he points out, the risk with the first view is that it assumes a stable world with no geopolitical risk, where demand management is more powerful than issues related to supply. Which means that if the first view is wrong, which means that inflation is actually driven by the economic war, then the second view is wrong as well, which means we are not at peak hawkishness. He goes on and details a big shift in the way that central governments, central banks, and geopolitical relationships around the world have changed over the last 5 years or so. US consumers bought cheap stuff from around the world. Europe got cheap Russian gas. Lower income households bought cheap stuff from China. But protectionism, tariffs, trade wars, and more recently, zero COVID policies out of China affecting supply chains, and the balance of economic power in Europe shifting towards Russia, with Europe reliant on natural gas from Russia, we have now entered into a war economy. This means that central banks' policy objectives have had to change. They used to think they were fighting a war against deflation from cheap resources, and now they're forced to clean up the inflation coming from an economic war. He reiterates that Russia is kind of like a GSIB of commodities, which GSIB stands for globally systemically important banks. So all of the large banks are designated GSIBs because if they were to fail, then they needed to be bailed out, because if they were to fail, it would cause a collapse of the whole entire global financial system. So they're labeled GSIBs. He points out here that Russia is like a GSIB for commodities and China is like a GSIB for factories, the two pillars of the low inflation world we used to live in. This means that the inflation that we are going to experience from here on out may not be as a result of the few $trillion that they spent and printed a couple of years ago, but might be continued as a result of geopolitical war. And not only that, but that might be the outright intention. If we have two great powers challenging the might of the US and the dollar, then inflation has barely started and could actually be understood as an outright instrument of war. And here he quotes Lenin saying the best way to destabilize the capitalist system is to debauch the currency. He then points out the trend that the Federal Reserve has been following in its transition from fighting deflation to fighting now inflation. First, they said inflation was transitory, and then they said there'd be no hikes. And then when they started hikes, they started at 25 bips. And then they went to 50. Now they're at 75. And the final statement that I'd like to read for you here is one of the last sentences in the article where he says, "Make no mistake about it. The risk of the Fed hiking to 5 or 6% is very real, and ditto the risk of rates cresting there despite economic and asset price pain." This reinforces what I've been saying for a while now, that the Federal Reserve understands that at the end of the day, if you don't stop inflation, the currency tips over into hyperinflation and you lose all purchasing power. The dollar is gone. Without the dollar, the United States has this much power. They can't do anything, because if nobody accepts the dollar, then nobody who's going to go enforce the power of the United States will accept that dollar for payment, which means that there is a very high likelihood relative to what most people think that the Federal Reserve continues to tighten even as the stock market continues to crash, even as bond prices continue to crash, even as unemployment starts a wave rolling across our economy. At some point, it will cause some sort of systemic risk with a GSIB failure or a government defaulting on its debt, some crazy thing happening that in my mind would probably then prompt them to reverse course. But apart from that sort of systemic risk, something that puts the entire global financial system at risk of collapsing, in my opinion, there's a higher likelihood that we continue to see tightening in the midst of a lot of economic pain rather than a pivot before we get down to low inflation numbers again. For anybody interested in reading the whole thing, I will link this article in the description below. And as always, I really appreciate you guys. Thank you so much for watching. Have a great day.